We're going to provide a quick market update for everybody. And I wanted to start with where we are globally. So global protein production has been stable since 2015. And prior to that, you can see the growth trend from 2000 to 2015, showing the increase in demand from growing populations and growing disposable incomes. But as supplies have stabilized, we are definitely seeing price increases as those tighter supplies are being felt. And that's really showing up with strong international demand, particularly in our beef exports that reached over 500,000 tons last year. This was the largest volume since 2002 and surpassed the high made in 2001. We also made a new record value at over $4.4 billion. But part of that record value is being driven by food inflation, as we're seeing inflation for a lot of commodities, but food products in particular. And whenever we talk about higher food prices or inflation, and particularly when you look at that graph on the left with higher retail beef prices in Canada, the question that gets asked is, are we going to see erosion of demand for beef? And obviously at these very high levels and prices that consumers are facing, it is a concern and something we're watching. But one of the key things when you think about a consumer standing at the meat case in their grocery store, trying to choose what are they going to take home with them, is what is that price relationship between beef with pork and poultry as alternative proteins? And the chart on the right shows that that price relationship is still in line with historical price relationships. You can see that big jump up in the second quarter of 2020 when we had the plant shutdowns, and this really did get out of line, but it quickly came back to those historical price relationships. And that's one thing that we're really watching, because at this point, we still have consumers that are choosing beef at retail as we have these price relationships in line. So when we look at what's happening with our cow herd, we did see cow marketings increase last year. It rebounded from the low levels that we had seen in 2020 when packing plants were prioritizing fed cattle to work through the backlog that we had after the plant closures. But those cow marketings last year still were below 2019 levels. So we had a national beef cow culling rate of around just over 12%, which is at liquidation levels. But it's one where when we start looking at the first quarter of this year, we've got total cow slaughter up 4% year to date, but all of that increase is coming from Eastern Canada, which is up 25%. And that could be partly due to some changes in how overproduction of quota is being dealt with in the dairy sector. But right now it appears that packing plants in the East are prioritizing cows, versus in the West, you can see that we would normally see a decline in cow slaughter starting about mid-March. And that actually started a full 4 weeks earlier in mid-February. And so cow slaughter in the West is down 2% year to date. And that combined with January exports that were steady with last year actually drops us out of liquidation levels for cow marketings in Western Canada at this point. But we still have beef cow inventories down about 1% on January 1st to about 3.5 million head. So when looking at those tighter supplies of cow marketings, we have seen a seasonal spring rally with Alberta cow prices up at about 96 cents. This is 9% above year-ago levels and the strongest for this time of year since 2017. But it remains behind the Ontario and US cow prices. And cow prices overall are really being supported by strong trim prices and reduced imports of manufacturing beef into both the US and Canada. Looking at the US side of things, their beef cow numbers on January 1st were down 2.3%, and that brings them down 5% from their 2019 peak. And the US, as we saw in the graphs from Matt, they are still in drought, and their beef producers are liquidating. Their beef cow slaughter is up 16% from last year. And so we know going forward that we have a smaller calf crop coming forward. And that is expected to start tightening supplies in the second half of this year. But before we get to then, we still have large supplies to get through. We've got total federally inspected slaughter up 2% year to date, with federally inspected slaughter up 2%. And this is the exact opposite story as cows, where in the West, our fed slaughter is up 3%, whereas it's down in the East. And it appears that packing plants are prioritizing fed cattle in the West. And last year, we saw really high slaughter rates, and packer utilization levels averaged about 94%. That surpassed the previous high made in 2004 of 91%. And we continue to see those high levels of utilization rates here in the first quarter of 22. And we really need the packing plants to continue to operating at these high utilization rates, because we have ample supplies of cattle on feed in both Canada and the US that need to be worked through. March 1st, cattle on feed numbers were up 9% from last year and 13% from the 5-year average. And despite the fact that we've had placements below year-ago levels since October, we still have large numbers of cattle on feed for 120 days or more that need to be worked through in the next 3 months. It's going into the second half of the year that we're going to start seeing supplies tighten up with those smaller placement levels in Alberta and Saskatchewan. In contrast, US cattle on feed continues to be large, and with the exception of January, their placement levels have actually exceeded year-ago levels throughout the winter. And February placements were actually 9% higher than year ago. And so expectations of when US fed cattle supplies are going to start tightening is being pushed further out, potentially into the fourth quarter. In terms of what's been supporting our fed marketings here in the West, it really is a story about feeder imports. And in the second half of 2021, our net feeder import numbers were very similar to the prior year. And this is going to keep fed cattle supplies ample in the first half of this year. In January, we remained a net feeder importer, but this is one where that number is shrinking. But as we see this number shrink, we also need to remember that our feedlot capacity expanded 19% in the last 7 years, and many of those pens are relying on feeder imports in order to fill them. But we are expecting these supplies to tighten going into the third quarter. And it's with those relatively tighter supplies in Alberta and Saskatchewan that we're expecting a stronger basis. We've seen a weaker basis here in the first quarter, but expecting that to really change here over the next several months. Last Thursday, we saw USDA release their prospective plantings report. And the real surprise was the fact that corn acres are projected to be down 4% from last year. And we've got to remember that this report was done the 1st of March, and over the next 30 days, as producers get into the field, there is potential for this to change. But overall, looking at US producers planting less corn and more soybeans, and the market really responded with the corn futures up and the feeder futures dropping down with that price pressure on feed costs. When we think about reduced acres for corn in the US, if you put in a trend yield of about 181 bushels per acre, and listening to Matt, that might be very optimistic at this point, but that would put a US crop at about 14.8 billion bushels, down 2% from last year's crop. And the US currently has very tight ending stocks of projecting to be around 1.4 billion bushels at the end of this year. And so if that crop is smaller with a smaller yield, that's going to put price pressure on corn this fall. Agriculture Canada came out with projections for barley earlier in March, actually, with acres of over 8 million acres, yields rebounding to be only about 6% below 2020 levels. And this one obviously very much assumes normal weather conditions and really depending on that potential moisture that Matt was talking about in May. But potentially this is a very optimistic number, highly dependent on timely rains for germination. So I'm just going to wrap up with some feeder prices, with corn trading on top of $7 a bushel US. It's had a direct pressure on the feeder markets, with the feeder futures dropping over the last 6 to 8 weeks. And so we have seen strong futures market offsetting some of these high grain prices. We've got projected prices for 850 pound feeders in August and September between 222 and 228. This is up from last year, which was around 192 to 194. But this could be tempered by a weaker basis as we see relative feed costs between Canada and the US. But currently, price insurance in Alberta is available for September at $2.18. On the calf side of things, we're seeing price insurance for calves in Alberta, top coverage for September and October, 226 in mid-March and 224 for November. And that's above the cash prices of last fall that were 207 to 224. So some factors to watch moving forward. We have strong red meat demand, both domestically and internationally, and exports are currently being supported by domestic production levels, as well as a strong futures market on the pricing side, but really watching to see when that shift in leverage happens and the tightening of supplies in Western Canada. And this is really going to depend on what happens with our feeder trade and how aggressive feedlots are at bringing in feeders and filling those pens, or if they're going to leave some pens empty. Right now, it looks like the packers are prioritizing fed cattle in the west and cows in the east. And we're going into probably a period with higher grain prices. There's challenges with the Ukraine conflict and situation just globally of expecting higher grain prices, even if we do see the rebound in production for barley in Western Canada. And there's lots of questions right now on how long that is going to persist, what can be the global production response on the grain side, and who is going to be supplying some of those food insecure nations that Ukraine had previously been supplying, or will they be priced out of the market? And right now, when we think about price inflation, it's just recognizing that our input prices are increasing faster than our output prices, really putting pressure on profitability and equity.